Investment advice offered through Stratus Wealth Advisors, LLC, a registered investment advisor, DBA True North Wealth Partners. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. True North Wealth Partners and Stratus Wealth Advisors do not make any guarantee or other promise as to the results that may be obtained from this. Investing involves risk, including loss of principal, and no strategy assures success or protects against loss. Vantage Point with True North Wealth Partners is for our clients and those wanting to learn more about what's really going on within the markets and economy, as well as overall financial planning topics.
Hey everybody, welcome to Vantage Point with True North Wealth Partners, Tuesday, November 15th, episode 29.
29. Hello,
Andy.
Eric Susie. Howdy, howdy.
Thanks for joining us.
Thank you, yeah. Can you believe it? A little snow made a little appearance over the weekend, and today a little bit of freezing rain. So here we are. Winter is here officially.
Yeah, it is. Yep.
And we have Santa coming. Cannot wait.
That's right here. That's right.
Man, that jingling. He landed on the roof. I heard the jingles, so it's going to be fun.
All right. You've been naughty or good?
Both. How about you? Yeah, we know better.
Yeah, right.
Well, good, man. Let's get into it. We got a lot to cover today. So how's things looking economic-wise, your stats? You know?
Yeah, I mean, just, the big thing, just not a ton of change. Things, trending down. Unemployment's still decent.
Yeah. Hanging in there for now. Yeah.
For now, right? Yeah. We've got layoffs on the horizon with tech's kind of leading the way right now, right? Facebook, Amazon, it's all going to trickle down at some point. And then you've got housing slowing, which is a big one. Retail,
it's going to be interesting. Yeah, retail is going to be interesting.
Yeah, people not spending.
On that, I had a client meeting earlier this week, and he's a truck driver. I always, it's a leading indicator.
Yeah,
I always ask him every time we meet. I said, "So how's it going?" You know what he said to me? Slow as molasses.
Really?
Very slow. So a lot of that is companies have extra inventory, so they're trying to burn it off. So I sort of get that, but it's going to be interesting if they can thread the needle, these companies, with getting the right mixture of laying off folks, using the inventory, or they may have to do discounts again after the holidays. Yeah. So
that's right.
I always like to hear what the clients are saying.
Yeah. Bad for the economy, but good for stocks, right?
Yeah. Yeah, I know. It's like
stocks like layoffs.
Yeah, it's a catch-22. It's like, bad news, good news, or whatever.
Yeah, it's crazy.
All right. Well, so let's hear it. Maybe we'll just get into a little bit of just some stats. Sort of, we had a nice little rally here, which is good. But I guess things to be aware of is just a GDP forecast, key dates coming up. I'm just going to rattle off a few you and I were talking about earlier.
Well, we had good news last week with the CPI.
CPI, yeah. So that came out lower than what was expected. So 7.7. So, anything that can be, like we've said, CPI inflation should have been peaked and is peaked, and now just coming down, but still sticky and elevated. So that's why the Fed is still going to be raising rates. Hopefully the Fed next meeting is on December 14th. The markets were pricing in 75 basis point increase. Now they're only pricing in 50 basis point increase. You and I were talking, hopefully 25. That's the stretch. Yeah. We'll see if we do get a 25, Santa Claus rally. But we'll see. Maybe a 50 with dovish talk could still spur it on. But we'll see.
Hoping for a push at the end of the year.
Yeah,
that'd be nice.
Yeah, it would be. But in the meantime, I'm going to rattle off some things that are still out there. So just sort of in chronological order here, to the most part, is midterms are still deciding on that for the House. One seat away from the Republican taking over the House. The Senate's still going to be retained by the Democrats. So whether it's 50 or 51 to be determined with the Georgia race runoff, that's coming on 12-6. So we have that still there. Russia is 12-5 as far as the European and Russia with the energy deal and shipments and all that. So that's something to still be aware of. I think you mentioned what happened today with Russia. Or
there's some fired a couple of missiles into Poland, I guess.
In the Poland it was. Yeah. Oh, I didn't hear that. Oh, jeez. Okay.
Yeah.
That's not good. So is what it is there. But so that's still, plenty of international risk there. Then we have on a CPI report, again, will come out the day before the Fed meeting. So 12/13 will be the next CPI report, Consumer Price Index report. Hopefully that is, curling down even more. That would be helpful. Fed meeting on 12/14. Again, 50 basis point max. Yeah. Hopefully 25. Then we have the CR continuing resolution or debt ceiling that comes due on 12/16. So there's a lot of stuff and shenanigans going to go on. So they're talking about doing the Secure Act 2.0. Maybe packaging all that in. We'll see if that can get done in time. Also try to raise the debt ceiling during the lame duck session before the House gets split. Markets typically like split, Congress, House and Senate to be split. But we'll see. So there's still a lot of things and noise out there to be aware of. Earnings forecast, just a couple little stats here. So Argus, which is one of our partners that we use for our research, they've lowered our earnings guidance here for 2023, 0.7. For 2022 is 0.7. 2023 is 1.3.
Yeah, and that's been coming down
all year long, right? And so, what is that? Another firm, Federal Reserve Bank Philadelphia, came out here November 14th. They see forecast for GDP to only increase 0.7. That's to say, excuse me, that's for 2023. Again, Argus is 1.3. Federal Reserve is 0.7 for 2023 and 1.8 in 2024. Goldman Sachs, on a call yesterday, it was disclosed that they said that this is earnings growth for the S&P. So earnings growth for the S&P, which has been double-digit, 10% or so plus for a while. They're saying without a recession in 2023, they're saying flat, 0% earnings growth. If there is a recession, it could be negative 11%. So, some headwinds there as well. Yeah. So you're going to hear the ugly word stagflation come out again. So that's just sideways, Yes, inflation's rolling over, but it's still high and sticky, but growth is rolling over as well. So it's going to, you're probably going to hear that word pop out again, stagflation coming. And, even our First Trust, with our guy there, he was still saying, bear market has further to go. Recession's highly likely in the next 18 months, is what he just said. Yeah. And then this came out, this is on November 11th from Northern Trust. This is a forecast. So you and I, we've always talked in our client planning assumptions. We use current market assumptions, data inputs that the software uses. And JP Morgan and other folks have come out and reduced their current market assumptions over the next 10 years. That was earlier this year. They released it. Northern Trust just came out with their current market assumptions for equities over the next 5 years. Basically, everything's lower, but just to give you, I'm going to quote here and just read a little bit. So he said the U.S. equities returns will be lower, but still acceptable, with total returns over the next 5 years at 6%. So typically S&P is closer to 10-ish. Yeah. Down to 6. Fixed income will settle in around 3.7%. Adding that to 60-40 portfolio, 60% equities, 40% bonds, should yield around 5.1%. So just overall lower as that. And this person spoke at the Schwab Impact 2022 in Denver, which occurred last week. So, just everything overall is just going to be just lower. Yeah. And their Northern Trust forecast for the GDP is to be 1.9% over the next 5 years as the U.S. goes through several important transitions from the pandemic to the endemic, globalization to reorganization, and from carbon-based energy to green energy. So meaning just overall GDP is going to be slowing across the world and globally.
Sure.
So I just want to get those out.
It's like trying to pick the score of the Super Bowl sometimes.
Yeah.
Right? It's like you got all these guys, they throw out numbers and it's like.
And it's as of today. Yeah. All this is going to change. But
Nobody
since it's sort of fresh and, people are getting near the end of the year, it's always good to sort of throw those up there. Yeah. What Andy and I are trying to say is just, hey, folks, the easy money is over. Like we've been saying, it's going to be harder for the next,
few years, probably.
Yeah, exactly. Big news. crypto. How's your crypto account? Are you able to get access to it?
Yeah. Well, they repoed my yacht.
Oh, did they? Yeah. I bet they did. Like, Andy, we need it. Sorry.
That's right.
So
yeah.
In the news, FTX. So that finally has cratered. So Andy and I, we correctly have stated we want nothing to do with crypto for our clients until it gets regulated. And so, regulation will probably come next year, and we'll see. But thank God we stayed out of it, and we saved our clients a lot of pain. So we take pride in that. But,
that's right. Yeah, we got a few that kind of a little bit, but nothing
crazy.
Not in the portfolios.
Yeah, right.
For the big part. Yeah, it's been nuts. It's a lot of news on that.
1 million folks are now affected by the bankruptcy.
Yeah, so we're talking about some of that money, going to Ukraine.
Oh, dude, don't get me started.
Crypto coming back to who knows? I mean, there's all kinds of stuff out there. But
he's the second leading Democratic donor after George Soros. So there you go. There's a big trail going on. But
see how that shakes out again.
Yeah.
Maybe not.
maybe not. Who knows? But yeah, you can't help but see that. This came from State Street, Spider. Their little LEI leading indicators. So leading indicators just shows the orange is recessionary and slow down. So we're right there. We just trickled into it. So again, this is just a leading indicator. This comes from someone else now, State Street Global Advisors. I always like to just point things out.
Yeah.
What's that? What do you hear?
What's that noise?
Oh my gosh. Is it Santa? Ho, ho, ho. Oh my gosh, Santa. Ho, ho, ho. Merry Christmas. Oh, Santa.
Oh, it's so good to see you. Give me a big Santa hug.
Oh, thanks, man.
Can I put my bag down there, please?
Oh, the kiddos are going to love all that.
Eric and Andy, it's so good to see you.
Yeah, Santa.
Man, it's been a while.
Oh, I'm sorry. Are we on TV?
Oh,
you want me to come back?
No, you just stay right here.
Oh, okay.
This is all for you, Santa.
Well, thank you so much.
We'll roll out the red carpet for you.
Thank you so much.
You're busy.
I'm very busy right now this time of the year, and we're getting busier by the day.
Good.
Let me ask you a question.
Yes.
How are those two little girls?
You mean Ella and Sophia?
Ella and Sophia, how are they doing?
They're a little naughty once in a while. So you
know what? They're on my good list.
Are they good? Good.
What about this? What about him?
You have to keep them there.
Hey, how about the elf? No, my girls really enjoy the elves coming. So why do you have the elves come down? I haven't figured that out.
Well, here's the reason we send the elves down.
Okay.
The elves go on the individual houses, and they keep track of the children. And they make sure they stay on the good list.
Good list. They
like
make the list.
And if they have a little problem, the elf flies back to the North Pole and lets Santa know.
That makes sense.
But then they go right back, and then most of the children wind up back on the good list.
Okay.
Well, that's good to know. Now, when do you do that? When does the elf on the shelf come out usually?
Normally, around November 23rd, they start coming. That's pretty soon. Their favorite night to come is Thanksgiving night.
That's when ours comes.
Yes.
That's
and the reason is that because people have eaten food all day.
Yes.
Some people drank all day. So it's pretty quiet in the house, and they can sneak right in. And they do that. They keep coming right up until December 1st. And then they're all in place and ready to go.
Okay. I have another question for you.
Okay.
This is from my girls. Okay.
Oh boy, I don't know.
So my girls always asked, mommy and daddy, how does Santa get in houses that don't have chimneys? Because there's apartments and, all that stuff.
Question.
Well, I'll tell you, Eric, up until about 100 years ago, almost everybody had a chimney.
Right.
It's very easy for Santa. But little by little, they started building apartments and townhouses and all different kinds of places for people to live. So Santa made this little key, and all he has to do is put it towards the lock, and it automatically takes the shape, turn it, and I'm in. So nobody has to worry if they don't have a chimney.
Nice. Way to go, Santa.
Yeah.
How's Mrs.? How's Claus?
Oh, Mrs. Claus is not just good, Andy. She's wonderful.
There you go.
I want everybody to know, without Mrs. Claus, there would be no Christmas.
Yes. Amen. Amen, right. Santa.
Everybody thinks Santa can do everything, and he can do a lot. Yep. But Mrs. Claus can absolutely do everything. I have a little question for you.
Yes, sir.
Santa has a lot of gardens up in the North Pole that he keeps covered and working fine during the winter.
Yes.
Do you know why?
I don't know why. Why?
So he can ho, ho, ho.
That's why that's a card. That's a great one.
I have one more question.
Okay.
So do you know why everything is so much more cleaner around Christmas?
No idea.
Andy, you have no idea?
No idea.
So everybody can Santa-size.
Santa-size. Oh, great.
Yes.
Oh, that's a good one.
Yes.
Oh,
Oh,
Santa.
man.
Too much, man.
Eric, I have to tell you, I have a little story I want to remind you of.
Uh-oh.
Oh, it's okay. This is a good story.
Okay, go ahead.
Andy, you might want to hear this.
Yeah, right. Yeah. Fill me in, Santa.
So when Eric was about 5 years old, about a week before Christmas, he got in a little trouble.
Yeah, I believe that.
And he was on the naughty list. And his parents told him he was on the naughty list. But I have to tell you what he did. He was so sorry. He told his mother and his parents how sorry he was. And he promised never to do it again. And Santa was so touched by that. But when Eric came out on Christmas morning, he wasn't sure which way it was going to go.
Yeah.
So he walked out, and all of his presents were there. And little Eric was so happy.
Yeah,
Thank you.
There you go.
Thanks for being a good man, Santa. And you know, Santa,
Absolutely.
to remind you, my birthday is Christmas.
That's right.
25th.
Birthday boy.
Well,
Christmas.
I already know that.
I know, but, well, you know, I guess
And
you do.
that's why you get a couple of extra presents.
Yes, that's why I love it.
Normally.
Thank you. Normally, right.
But you still have some work to do this
I do.
year.
My
Yes.
grandpa Co, he used to say, Eric, watch out. You're going to get a black lump coal in your stocking. My grandpa Co used to tell me that.
Now, Andy, on the other hand, has always been on the nice list.
Yeah, that's right.
And
That's
he's
right.
still on the nice list.
Good.
Thanks, Santa.
So, Eric, maybe you can learn a little bit from your friend Andy.
Yes, I can. That's why we're good partners, yin and yang.
Exactly.
Well, we appreciate you taking the time. I know, Santa, you were busy. You have your Santa's Christmas hearts. That's what he does for folks. So, folks, if grandparents, families with children, if you want to have them out for a private party, home, an event, what have you, we'll put up his information. Nathan, our producer, will take care of you, Santa. So you can reach him by email, phone. He'd love to stop by and make a visit. So reach out to Santa. Again, we'll put all his information up for you.
Well, thank you so much for that. And let me give you a big Santa hug before I go.
You're a good man,
So
Santa.
good seeing you
We
guys.
appreciate you. You stay
So
well.
good. I will.
right.
All righty.
Thank you.
Thank you.
Whoa!
All right, Santa.
Merry Christmas.
Thanks,
See ya. Wow. Our own True North Santa. Is
That's
that
crazy.
awesome? Woo. Way to go, folks.
Man,
It doesn't get much better than that.
takes a break out of his busy schedule,
Yes.
come down here and see us.
We're very fortunate.
That says something.
It's connections. It's who we know, right?
That's right.
Anything else on your mind? What do you got going on there? You
Well,
got,
I mean, talking about recession, right?
Yes.
So pending recession. So it's always like, well, as an investor, what should I do or change, if anything, right? So you have your long-term investments, right? It's like you just want to be diversified, ride out the market. But yeah, if I'm sitting on cash, right? Like what are some things? Interest rates have gone up a little bit, right? Credit card debt. During the pandemic, right?
yeah, what are we?
Printing money, and it was like savings rates were high. And now all of a sudden, it's like a report just came out today: 15% year-over-year growth in consumer credit card debt. Wow, highest in I think 15 years.
So that means people are living
putting money on credit cards,
card, right?
Yeah.
That's good, folks.
And especially heading into recession, that's not a good.
No,
sign,
it's not.
Right?
So that's when, with higher interest rates, so credit card companies are charging 22, 26%.
Yep.
So let's get in more debt, and you have higher rates on that, and it's just a snowball. So it's not good.
If you get laid off, then,
yeah.
it could be a nightmare. So anyhow, but so what do you we can maybe talk about this later.
Tips of the month. Want to hit into that on options or
Yeah. Well, just thinking.
go ahead.
Just thinking through what do we do with what if I'm sitting on cash? What do I do? Right.
Yeah. Well, there's the options are the CDs, the fixed annuities, things of that nature. So, I guess we'll just sort of jump into that if you don't mind.
Yeah,
since
that's
you
right. Yeah,
brought that
sorry.
up. Yeah.
Kind of crossed the line and the tip getting off your schedule.
No, it's all right. But that was tips of the month.
Tips of the month. All right. So we're in the tips of the month. So you've got
That's all good.
high interest. So you've got sitting on cash.
So with higher interest rates, finally, we can use it to our advantage. So yes, we can bring to our clients now CDs in-house internally. So Schwab, they bank Ally, PNC, JP Morgan, Chase, or Schwab has their own. So just last night, we rattled off a 1-year CD, 4.7%.
Yeah.
So So we can offer that to you. So another thing is, again, fixed income annuities have been dead for a while because the rates have been low for 10
Did you say the A word?
We did. The A. It's not that word. It's the annuity word. There are, yes, certain times when annuities are a suitable fit. And I actually, I've used both already over the past month. So you and I and Eric, we've all been fixed index annuities and the CDs. It's simple, yeah. So, right now rates are 5.6% fixed. There's a trigger of 10% tied to the S&P, and then there's a cap of 12%, which we can get into later. But there's 3 options, vehicles one can use for your fixed income annuity if you wish. Pick one of the 3 or all 3, third, or 50-50. Just use 2. And it's a year over year. And so it's a nice option that we have another, arrow in our quiver to use. So
options,
yeah, so that's great. Now we can finally utilize higher rates to our advantage and for our clients' advantage. Finally,
that's right. Yeah, especially too, if someone's thinking, "Hey, this has been a pretty volatile year, right?" Yeah. So we've had 10 years of pretty good growth.
Yeah, easy money.
Yeah, when you talk to someone about their risk, oh yeah, no, I'm good, and then all of a sudden it's like, okay, maybe I'm not so good.
We have this option.
Yes, exactly.
And then plus we're still going to be using our alternatives and M&A funds. Those are all doing great this year, and the next year they still should be doing well. Also, tips of the month. Again, what we've talked about, we didn't think it was going to hold up as far as the Student Debt Relief Program Act that Biden, executive ordered through. Federal Appeals Court came out and blocked it, so non-constitutional, et cetera. So basically what that means is, folks, if you do have a debt, student loan, be prepared. They're going to turn on that payment switch back in January of 2023. So higher rates. Now you got student loan, and all this. It's all like, there's a lot of headwinds still out there. So we want to point that out. Just tips of the month. Something that's unique came out today from Hedgeye, from Neil Howe, our demographer there. He just mentioned, I'll hold this up and Nathan will show this as well. This just shows occupancy rates for offices pre-COVID, pre-2020. Was upper 90s, 90%, upper 90s for the occupancy rate. Then it crashed, and you can see it. So these are the 10 largest cities going across. The red line is the average of the 10 largest cities. Well, it's only under 50%. Let's call it 49%. So basically, 49% of the offices in these large 10 cities are being occupied. So far from the upper 90s that used to be. Huh. So that just means people are working from home, and the companies, a lot of employers, some are liking it, some are not, but it is what it is.
Sure.
So I got to ask you, so what's what day of the week do you think people are playing around, getting the robo hand moving the mouse? I'm here. I'm working. Or swink. So what day do you think?
The least?
The least.
I'd say Friday.
Yeah. So yes.
Or Monday.
Yeah, Friday and Monday. So anyway, so Friday is the number one. So this is the office occupancy rate by the days of the week. So this is pretty cool. So Friday is the least. It used to be, it's 30%. So 30% of the folks are now in the office on Fridays. That's the least amount. Second, it was Monday. Now it's 39% for Monday or back in the office on Mondays. Then you can see Tuesday, Wednesday, Thursday, or 47, 47, and 44 accordingly. So it just shows you, which makes sense. People want 3-day weekends. So that's why they're doing that. But I thought that would be interesting tips of the month from our guy. But
sure. Yeah, maybe we can get down, or maybe take over the Nationwide building downtown.
Yeah, plenty of vacancy office space around here, even in our building. So yeah, it's right. People are I've mentioned that. Yeah, it is. It's happening. Anything else before we jump onto the closeout here with charts and?
No, that's okay. Yeah, that's pretty much it.
Yeah, so there's a lot going on, still a lot to come. You'll see some tweaks as always, but blow through these charts. You've seen this all, nothing new to you, but the VIX volatility, okay? The CBOE VIX average is 18.6. This is looking at 30 days in the options market. Right now it's 23.7. So remember, we're still in that chop bucket between 20 and 30, and we're going to continue to be in that for a while. Pullbacks hasn't changed yet. That 11 number is still there. I thought we might hit 12 by now, but I'm still anticipating us hitting 12 pullbacks of 5% or more in the S&P. The average is 4.6 times per year. Stock market earnings. So again, two different axes. The S&P earnings are on the right. The point is they're coming down. They're curling over from the high 200s, like 220-ish coming back down. So right now it's around 218. So earnings per share, that's what we're talking about. One firm mentioning flat for next year, possibly. Yeah. So no growth. But that's what you want. You have to have that come down. And then you can see the stock market on the left axis, the S&P. Earnings growth rate, again, it's coming down, but we still need to get it down. So right now it's 10.4. The average is 7.9. So as it comes in line, that just helps reset things, setting us up for the next bull market, hopefully back half of next year. The tale of two halves is what we predict. Yep. The 2s and 10s, so the inversion of the 2-year, 10-year interest rates, the inversion's still there. It's about 54 basis points right now. So that's deepest in 30, 40 years, et cetera. So this is just the inversion of the 2 and 10 year. It's just showing the curvature of it versus the average for the 10 years, 2.31. And right now it's 3.88, has come down. It was over 4. And then the 2 year, the average is 0.99. And right now the 2 year is 4.4. So that's the Fed can control the short end of the yield curve. They cannot control the long end of the yield curve. That's why you have to follow the bond market. The bond market leads the equity markets. And here's the inversion, like I talked about. It's 0.52 negative, but it does lead into a recession. It's an indicator. Mortgage rates over 7.1, but as rates have come down, so this will probably come off a little bit, but again, straight up. So that's why people are sitting on their hands. They're called rate locked, so nobody's moving. I think there were 4 houses for sale in the neighborhood-ish area that I live. Used to be a hand over fist earlier on, and the prices were a lot higher than asking. So now I'm starting to see prices undercut. Plus, there's only 4 houses listed. Yeah, no one's going anywhere. It's rate locked. The balance sheet for the Fed is curling over. Was over $9 trillion. It's about $8.7 trillion, and they have the quantitative tightening of the $95 billion, I believe, per month. They're trying to let run off. So that's a automatic rate increase without having to raise rates anyway. So you have that working underneath the current there. Federal Reserve dot plot, you can see the end target rate, terminal rate they talk about, it's around 5% or so. So you'll see it go higher, then they'll have to reverse engines, cut rates. Back half of the year, markets will take off. So that's what we are anticipating. GDP growth rate, okay, negative first quarter, negative minus 0.6, negative second quarter, positive third quarter, 2.6. Fourth quarter, it should be positive, but it's going to be slower and grinding. This is a leading indicator, LEI, leading indicators. These are metrics that forward and share with you what the economy, it went negative 1.4%. So again, not good. That just projects what is to come. Service debt, what you talked about earlier, and credit card and the household level debt, everything's gone up. Consumer debt, household debt. So coming off the lows of nothing is just, it's definitely taken off. So, CPI index, came down to 7.7, like we said. So still off the highs of the high 8s, obviously, which is great. But you have the core, which excludes food and energy. But the Fed likes to use the PCE, the personal consumption equity inflation index there. But the core, again, it's curled over, coming down. They want to get that number down to 2. So again, it's going to be elevated still for next few quarters at least. That's why sticky inflation. Supplies of new home inventory, that's gone back up. Okay, remember how low supply it was in 3 months? Now it's about 9.2 months of supply. The average is 5.8. Oil and the dollar. Remember we talked about the dollar last month. We want to see the dollar come down. The dollar reverse. You can see how it was like a 114. Now it's down to about 107 or so. And then oil, again, has come down. It fluctuates, but it's in the 86 range per barrel. Again, bull market cycles. You can see a lot more bulls than bears, but yes, we're in a bear market cycle. The key is 2 questions: how long and how deep will it be? The length, it's looking like it's going to last a little longer than a year, obviously. But now it's like how deep. We don't think it's still going to be that deep. More of a shallow bear market / recession. But that's just things that, indicators. Yep. Savings rate, we talked about that. It's 3.1. So 3.1% is the personal savings rate. The average is 6.8. Come off the 2 years of over 30% free money. Okay. Those days are long gone. However, even though there were some curious states that right before the elections gave inflation checks out, direct deposit, just to buy those votes. But hey, they'll do it. They'll do whatever they have to do. Corporate leverage debt loans. You can see the corporate debt. 12.6 trillion. So still high, about let's call it 50% of the GDP. Basically, half the GDP is leveraged. And the Bitcoin and dollar. So remember, Bitcoin was $60,000, $70,000 per crash down. Now 16,000.
Yeah,
so
crazy.
That's what we saved our clients a lot of pain. Dollar went straight up all year long, come off the high from 114 or 15, come off around 106, 107 right now. But, that will help. You do want the dollar to come in to help the overall stock market. Lastly, we'll end here on the consumer price index, the components. So that's why we're pretty comfortable saying things have peaked, the vast majority of them, but they'll be sticky. So you can see the peak and troughs. So the current is where the blocks are. You can see the peak is the diamond, light blue. So pretty much everything is underneath the blue diamond shape. So everything's come off the peak. So those are the components of the CPI. Again, the house shelter is still going to be there, sticky for another 9 months or so. That's a lagging component to that. So I know we covered a lot of charts, tips of the month. Santa, it's great to always see him. Glad we had him. He's a good man. And let's see, we'll keep on working our magic here, losing you less and doing the best we can. And again, between now and the end of the year. So enjoy
Have a great
Thanksgiving.
That's right.
Enjoy the holidays. Merry Christmas is around the corner. Hanukkah as well. So we'll hit all that up. Enjoy, everybody. Reach out to us. Any further questions.
So long.
Stay well.
Bye.
You can reach this episode on our website at mytruenorthwp.com, by other podcast venue sites, or by calling us at 614-929-2715. Also, feel free to share this episode with friends and family and sign up for our weekly email market updates via our website. Special thanks to our producer Nathan, as we will be producing these episodes on a monthly basis. Investment advice offered through Stratus Wealth Advisors, LLC, a registered investment advisor, DBA True North Wealth Partners. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. True North Wealth Partners and Stratus Wealth Advisors do not make any guarantee or other promise as to the results that may be obtained from this. Investing involves risk, including loss of principal, and no strategy assures success or protects against loss.